There's this moment almost every investor goes through at some point where you open your phone, you suddenly see your portfolio bleeding red, and your stomach drops a little bit because suddenly the money you worked months or years to build in your investment portfolio feels like it's disappearing in real time. And your brain immediately starts telling stories about what does this actually mean, and maybe how this time would be different. Maybe the market is never going to recover. All this is just noise in your head. I honestly feel like I need to be making a video like this every quarter because markets have just been so turbulent nowadays and there's just so much fear out there on social media. I remember early on when I first started investing, I thought I understood market volatility, but I didn't understand what it felt like emotionally until I had lived through my first real downturn. Because it's one thing to say markets go up and down, but it's another thing to watch your own money swing thousands of dollars in a matter of days and still have the discipline to do nothing. And that's when I realized that investing isn't actually about picking the perfect stock. It's really about whether you can manage your own reactions and have a strong emotional foundation. So when things don't go according to plan, you don't want to be the one that panic sells all your investments. Panic selling happens to the people that don't think clearly, the people that feel trapped, overwhelmed, and scared of the future. What makes this even harder today is that we live in a world where every tiny market swing is blasted across all of social media, all of the news headlines, all the YouTube thumbnails. They're designed to make you feel like the sky's falling. And when you combine all this noise with a red day in the market and seeing your portfolio drop thousands, and you suddenly feel like that normal pullback that happens all the time is now the beginning to the end. Even though just zoom out and look at the big picture and long-term history, you'll see that markets have always moved in cycles of fear, cycles of optimism, crashes and recoveries. And yet every single time this has happened, the markets have gone up and recovered. The uncomfortable truth is that the market doesn't care about your timeline, your goals, how much you have invested, because volatility, you just never know when it's coming. You don't have that crystal ball. When you panic sell during a downturn, you're not avoiding the risk, you're just locking in the worst version possible, which is you're locking in selling your shares at a lower price. You don't want to be selling after your shares have already fallen and then just sitting on all that cash because the cash is instantly losing value too. You have inflation you're dealing with. And then on top of that, you just sold when all your markets are down. And then what's going to happen is that you're going to get FOMO when the markets do go up and then want to put your money back into the markets. Well, when you sold, you just paid taxes. You just lost on the opportunity to dollar cost average your way into the market while everything was at a fire sale. And then that's not going to set you up for being a long term investor because you have the mindset of panic selling whenever things don't go right. So, one of the most powerful mindset shifts you can make is to stop viewing market drops as something that's happening to you personally and start seeing them as part of just the normal system of investing because it is a normal event. It might happen more frequently in recent times, but it's normal to have market swings. Volatility is going to scare some people out of the market, and long term investors are the ones that are going to be rewarded over the decades. Because when the prices drop, you're actually just buying the same quality company, the same quality shares at a discount. And you're going to be accumulating wealth while others are locking in losses. A big part of staying calm in chaotic markets comes down to having a plan before emotions show up in the worst way possible. Because when you already know why you're investing, if you already know what your time horizon is, what kind of risk you're choosing to accept by the stocks and ETFs that you're invested in, then you understand that a bad week, a bad month, or even a bad year doesn't automatically ruin your investments and turn it into a personal crisis. It won't be as stressful because you're thinking long term here. Long term investing is going to have its ups and downs. There's going to be messy chapters in it. But you realize as a long term investor that when the markets drop, it is your opportunity to then transfer wealth from those panic sellers to you because you're buying the shares at a lower price and they're locking in losses. It also helps to be honest with yourself about what kind of investor you actually are. Because if you find that every market dip makes you want to hit that sell button, that's usually a sign that your portfolio might be taking on more risk than you can emotionally tolerate. And there's no shame in that. It's just you have to understand where you sit. Maybe invest in a lower risk ETF if you're the type of person that's going to sell when you see your portfolio dip. And if you have the emotional discipline, go ahead and invest in those tech ETFs because they're going to have bigger upsides and bigger downsides. Your investment strategy is going to be useless if you abandon it the moment everything becomes unstable and uncomfortable. If you zoom out far enough, you start to see that nearly every major market crash in history felt catastrophic while it was happening. And yet, over periods of time, those moments became small dips on the chart that trend upwards. And the people who benefited the most weren't the ones who perfectly timed the bottom. However, those who did time the bottom, they turned out really good because their investments 5x and 10x. But the people that win in the long term are really just the ones that stay consistently invested. They kept contributing, and they didn't let fear talk them into abandoning their long term plan when it felt unbearable at the time for your emotions. Think about during the COVID dip. Remember how, now that one's a little different of a circumstance because it was a pandemic, but really, like, all these businesses weren't just going to go out of business the next day. I mean, you have Walmart, Costco, Facebook, Google, everything dropped because there's so much widespread fear. And it was a really bad pandemic, don't get me wrong. There was a lot of bad things about that pandemic, and it was a tough time for the world. However, thinking long term, as long as this isn't the end of the world, and I truly didn't believe this was the end of the world, markets were going to recover. So I just dollar cost average into the market during that time. And what do you know? A couple years later, markets are at all time highs again. So, long story short here, just don't get caught up in all the fear that is pumping in social media about every single market crash, every single world event, because you just need to focus on what you can control and be a long term investor. At the end of the day, building wealth through investing is less about being fearless and more about just being patient, because fear is going to show up whether you like it or not. And the real skill is learning how to feel that fear and harness that fear without letting it drive that steering wheel of your investments. Remind yourself that you're playing a long game in the market that has always rewarded discipline over quick reactions. So if you're starting your portfolio right now and you have that tight feeling in your chest where you're like, oh, I don't want to invest now because the markets are just too turbulent, just know that you're not alone with this feeling. There's a lot of people that are feeling this online. You're experiencing this exact emotional test that separates long term investors from short term investors. And just remember, time in the market will always beat timing the market. If you say long term invested in the market and dollar cost average, your financial future is going to look way brighter than somebody trying to time the market on individual stock picks and trying to time the market before market crashes or market booms. That's all I had in this video. I just wanted to talk through this current situation because I know there's a lot of market turbulence out there. If you want more personal finance content and you like what you see, give this video a like. I'll be posting multiple videos a week about various personal finance topics. And thank you all for listening to the end. I'll see you all in the next one.